Hi, my name is Billy Flowers and welcome to my channel where I talk about velocity banking and how we can use this strategy to massively pay off debt. So in today's video, we're going to be talking about how to pay off a $10,000 personal loan. So let's see how it's done. As always, we're going to start with our four key numbers. We have our income at $3,000. Our expenses are at $2,250. Our debt is our personal loan at $10,000. And our cash flow is at $750. Now, we do have a line of credit for $8,000 and it has a 13% interest rate. And our personal loan is $247 per month. And the interest rate is 16.75%. Yeah, that's a pretty high interest rate, but it's not out of the ordinary, especially with these types of loans. And the loan is for a 5-year term for 60 months. Now down here, I have the amortized schedule for the first 6 months broken down into the interest and the principal. So for the first month, you're going to be paying $140.02 in interest. So $140 of $247 payment is going towards interest. Now, when you look at this, you can, just by looking at this, you can tell that this is not 16.75%. Just by looking at it, it just doesn't look right. But as usual, we're going to get on Google and we're going to see what the percentage is that we're actually paying, especially at the beginning of this loan, and see how much the bank is making. So you're going to go on Google, like I said, you're going to put in $140.02 is what percent of 247. Now, I already put this in my phone. Whew, whew. And this one, I've done this in the past, but this one right here, this one right, whew, get ready. 56.69%. 56.69%. That's how much interest this is. 56 point. No. See, this right here, these types of loans right here, you need to pay off as soon as possible because you getting robbed right here. No. So we gonna keep going. So like I said, the interest that you paying, $140.02 for the first month, and only $107.93 is going towards the principal. Month 2, you have $138 going towards interest and $109.44 going towards the principal. Month 3, $136.98 going towards interest and $110.97 going towards the principal. Month 4, $135.43 going towards interest and the principal, $112.52. Month 5, we have $133.86 going towards the interest, $114.09 going towards the principal, and in month 6, we have $132.27 going towards the interest and $115.68 going towards the principal. No. Us velocity bankers, no, we ain't putting up with this. So let's see how this is done. So we have our line of credit of $8,000. So we're going to use $8,000 for our first chunk, and we're going to put it on the principal of this loan. And what that's immediately going to do is push the amortized schedule all the way out until January of 2029. You're seeing that, right? So we're going to have about $2K left, of course. And when we make our regular monthly payments, because we're still going to be making our regular monthly payments, remember, it's part of our expenses. Now, only $32 is going towards interest and $215.19 is going towards principal. See, I like the way this looks. Don't you? This looks a lot better. I can work with this. So let's keep going. So we're going to have our income go in to this line of credit. It's going to bring the balance down to $5,000. And then our expenses of $2,250 is going to come out of the line, bringing the balance up to $7,250. And then we're going to get charged $78.54 in interest, raising the balance up to $7,328.54 at the end of month one. Month two, we have our income going in, our expenses coming out. $6,578.50 is the balance. $71.27 is the interest. $6,649.77 is the balance at the end of month two. Month three, we have our income going in, our expenses coming out. $5,399.77 is the balance. $63.91 is the interest. $5,963.68 is the balance at the end of month three. Month four, we have our income going in, our expenses coming out. $5,213.68 is the balance. $56.48 is the interest, raising the balance up to $5,270.16. So what are we going to do? What do you think? We have $2,000 left on our loan. So we're going to go ahead and pay that loan off, because we don't want to have this monthly payment no more. I mean, we don't need that. See, we're trying to get rid of this loan, so we're not paying no kind of interest. We don't want to pay nothing. So we're going to pay this loan off. So now, since we paid the loan off, what else is going to happen? This monthly payment is gone, right? It's bye-bye. It's gone. So what's that going to do is we're going to minus $247 from this, right? $247 from our expenses. So now our expenses are going to be $2,003. And then, of course, what else are we going to do? We're going to get that cash flow, right? We're going to get it. So we're going to get this cash flow. So we about to get this cash flow, right? Plus $247. So I think my math is good. That looks like a $997. So we close to $1,000 right here. So $997 is our new cash flow. That's what we're gonna be working with. So after we add $2,000 paying off our loan, the balance is going to go up to $7,270.16. And then we're going to have our income going in. And then it's going to raise the balance up to $4,270.16. Now, you see that number right there? That's our new expenses. $2,003. Raising the balance up to $6,273.16. Interest, $67.96. Raising the balance up to $6,341.12 at the end of month five. Month six, income in, our new expenses out. $53.44.12 is the balance. $57.90 is the interest, raising the balance up to $5,402.02 at the end of month six. Month seven, income in, expenses out. $4,405.02 is the balance. $47.72 is the interest, raising the balance up to $4,452.74 at the end of month seven. So we have month eight, same deal. Income in, expenses out. $3,455.74 is the is the balance. $37.44 is the interest, raising the balance up to $3,493.18 at the end of month 8. We got month 9 here. See that? Our income's going in. Now, our balance is all the way down to $493.18. Yeah, you should be starting to do the two-step. About to do the two-step because we about to know, we know what's coming. So we got our expenses coming out, $2,003. Raising the balance up to $2,496.18. We got the interest right here of only $27.04, raising the balance up to $2,523.22 at the end of month 9. And this is where you're gonna start salivating at the mouth because you already know we've been putting in 3,000 this whole time, so you already know the drill. As soon as these expenses start coming out of our line of credit, we're gonna be paying them until we put in that exact amount, zero this line of credit out. We're done. 10 months. We're done with this $10,000 personal loan with this high interest rate, starting off with $750 of cash flow. Now we're gonna go over here for a minute. If we just would have paid this making our regular payments, you would have paid $4,831.01 in interest. I mean, if we just did some simple math, 10% of 10,000 is 1,000. You see that over there? That's 4,000. So that's more like 48%. Isn't that crazy? But I thought this was only 16.75. Yeah, this is going into the bank's bank account, not your account. The bank's bank account. Nah, we ain't playing that. The interest that we actually paid on the loan, doing what we do, us Velocity Bankers do, we only paid $109.80. That's it. The interest on the line of credit doing all of this, $508.26 for a total of $618.06. We saved over $4,000. That's what you save. So look at that. Now it don't make no sense. We saved over $4,000. So this loan right here, you might need to use it for something, maybe for some self-improvement or something, maybe a project or something to fix at your house, but now this looks a lot more reasonable. You only paid $618 in interest total. I mean, I'll take that for, $10,000. It's not too bad. You know what I'm saying? What else would I like to do? I like to see if we actually paid this 13% on this line of credit. So we're going to do what we do. We're going to put this in Google, right? $508.26 is what percent of 8,000, right? So what we got here? I already put this in my phone too. I'm ready. You ready? I'm ready. All right, I'm gonna write this one down. 6.35%. That's what you actually paid. Now, I've been doing a lot of videos on this, so this shouldn't be surprised. You might pay a little bit more than this depending on how the interest is and how you get paid. Of course, this is a perfect scenario, and you getting paid once a month. So there's no telling. Everybody's situation going to be different because I don't know exactly when your bills are going to be coming out and when you're going to be getting paid. So this is how you pay off a $10,000 personal loan, starting off with $750 in 10 months. Oh, and I forgot to tell you, this is where you would be in 10 months if you were paying it just the regular way. You would still be getting charged $125.29 on that month 10 in interest, and only $121.90 is going towards the principal. See what I'm saying? These amortized loans, nah, you got to get away from these. So with that said, I just want to thank you for watching today. And don't forget to like, subscribe, and comment below. And like I always say, get that cash flow.